Good morning, good afternoon, and good evening, everybody, because you are going to watch this video on a different time. Today, I'm going to talk about the seminar that are planning with John, a Dean of Faculty of Finance and Banking at the Vietnam National University. Right now, it might change. It would be a 2-day sessions. One day is for the actuarial practitioner, and the other day is for just the insurance, business operation, and management. And as you see, I'm going to show today the IFRS17, which is a new International Financial Reporting Standard. 17 means is for the insurance contract liability. And I'll briefly introduce myself. And now I'm working for the Institute of Actuaries of Korea in Seoul. My job is to provide the education and training for the industry people, and also the Designate Professor and Special Advisor for the Insurance Accounting Committee, and also the IFRS17 Implementation Task Force team. I'm sitting there to give an advice. And I'm also a freelancer consultant, and I'm teaching at the master program of Actuarial Science at the Sungkyunkwan University here in Seoul. And as you see, I have the bachelor degree and master degree from the Seoul National University, majoring economics. And I also got the master degree from the University of Waterloo in Canada after almost 7 years of experience in Korea. And I had been in the PhD program at the University of Waterloo before I get a job from the AVIVA Canada in Toronto. And later I moved to the Dion, Durrell&Associates, which is an actuarial consulting in Korea. And I came back to Korea. So you can see I have a very extensive experience from life and non-life, or in Korea and Canada. So during the seminar, I would like to share my knowledge and skill set as an actuarial professional in the industry with you. And we will cover some of the traditional, the insurance business operation and management, starting from risk management and underwriting and claim procedure, and also some of the product development. And the other one is focused on the actuarial practice. It includes the traditional rainmaking or pricing, or reserving, or economic capital modeling, which is for the Solvency II. And we can show and share some of the knowledge for both areas. And today, just to advertise our seminar, to encourage you to attend the seminar, I'm going to show you just a little bit of how the IFRS 17 works. Now, the implementation year would be delayed from 2021 to 2023 because some of the countries are strongly opposing only 1 year delay, so postponement. So it would be 2023, all the countries that made a decision to adopt this new IFRS 17 standard, they will start producing the financial statement based on the IFRS 17 standards. So during the seminar, I'm going to interpret and how we can convert the principle in the standards into the actual actuarial procedure and actuarial models to provide all the figures to prepare the financial statement. And briefly, from the IFRS 17 standards introduction overview is to establish the principle to measure, recognize, measure, and present and disclose of the insurance contract issues. So financial statement is going to show your entity's financial position and financial performance and cash flows of an entity. So that is the overview, the objective, and the standards number 1 clause, it also states the same thing. And why the European countries, European Parliament, they tried to set up the IFRS 17 is because it's going to show some of the comparability across the jurisdictions, countries, and products, and also it's going to increase the transparency, meaning that some like analysts or some investors in the market, they could understand clearly your companies, your entities, financial all related information from the financial statement. And they have an agreement on we need a common global insurance accounting standards, but they have been discussing it over more than 10 years, maybe 15 or 20 years, all the detailed information. So that's why they come up with the set of standards instead of some of the rules or formulas or technical details, just set down the principle. So next page, you can see why they are interested in this new IFRS 17 standards, clearly set down the principle so that the financial statement users in the market from all over the countries, they try to increase the comparability between different countries or different jurisdictions, even for different industry or different products. So they can compare with the same condition. So some of the market resources could be available fairly in the market. And this one is objective. So IFRS 17 standards number 1 clause, it says establish principle. I'm going to repeat: recognize, measure, present, and disclose. So this one should be, like all the principles that I can just summarize, interpret to you how we can convert this principle to the actual practice that you can, on a daily basis, you can work on it. And this one is quite long and very thick booklets, but today with this video, I'm just going to show you a little bit of, very essential part, which is called the measurement. So we call it the general measurement approach from the standards, and later it is called, outside of this booklet, industry people, especially North America or Europe, it is called building block approach. And I'm going to show you some of the pictures, but this is how it works. When we accept the new policies, I would say when we assume the new risks, we need to group those contracts differently. So I'm not going to measure the insurance contract liability as per each individual policies. I'm going to group any new policies differently based on the initial measurement. So for example, a bunch of new contracts coming in, let's say 14th or 15th in any month. And we need to immediately measure it. That's what we call measurement on initial recognition. It doesn't matter. And we have to get ready, or we have to do another additional measure subsequently when we have the reporting time. So measure on initial recognition, it is going to happen anytime when you have the new policies coming in. And the structure of that insurance contract liability, it is composed of two big chunks. One is fulfillment cash flow, and the other one is contractual service margin. We call it CSM, and this is, we call it fulfillment cash flow. It is also comprised with three different building blocks. First one is estimate of future cash flows, and the other three, building block 2 and 3, are adjustment. The first one, building block 2, it is to reflect the time value of the money and the financial risk related to future cash flows. That is the first adjustment. And the other adjustment is for the non-financial risk. Building block is dealing with the financial risk of the future cash flow, but this one is non-financial risk. Later, non-financial risk is going to be split into insurance risk and non-insurance risk. And non-insurance risk is also split into lapse or persistency risk and expense risk. I'm not going to go into the detail. And these two adjustments are very essential, and especially the risk adjustment is a new concept opposed to risk margin in the Solvency II. And those two are combined together. Building block 1 to 3 comprises fulfillment cash flow. The way how it calculates is that even though this is all stochastic future cash flows, that fulfillment cash flow, if it is a net outflow, it means this could possibly be onerous, meaning that loss making. If it is a net inflow, which the fulfillment cash flow shows negative, it means it potentially have the future profit. So both cases could be determined the sign plus or minus for the fulfillment cash flow. If it shows plus, we call it, this is an onerous group of contract. If it shows negative, it is a non-onerous, the profit-making group of contract. The reason why I'm mentioning is that when you come up with the fulfillment cash flow sign, it means you are doing or you have done the onerous test, whether this selected group of contract would be onerous or non-onerous. The standard says you must not mix the onerous group of contract with non-onerous group of contract, because it might offset each other and you're going to lose very important information regarding the future potential profitability. So onerous test is a very new thing and one of the key components in this new IFRS 17. And on the initial recognition, you come up with the insurance contract liability. It's not recorded on the financial statement right away. You just measure on initial recognition and wait for next following reporting date. And the result is the building block 1. And when I say expected value, meaning that traditionally we just have some set of actuarial mathematics formula to put. And then make the best assumption of, for example, mortality, morbidity, or some of the like claim frequency and severity. We just plug it in and to have the results of the given formula. But IFRS 17 standards clearly say that its objective is not to derive some of the most likely outcome or more likely than not outcome. So it's not just calculating the results, the figure itself. You should simulate all different scenarios, and it's all like probability, and you have to get expected value and probability weighted mean. It clearly say that, and I would accept it as like stress it again. Probability weighted mean. Mean itself is a probability weighted, so it is like try to stress this building block 1's characteristic. So expected value of full range of possible outcome of future cash flow, which is very essential, and most people, they don't understand fully, and some of the like insurance companies might go in a wrong direction using the traditional, just formula-driven approach, and they're going to be in trouble. That's building block 1. And then building block 2 is, I would say, adjustment. And building block 3 is the risk adjustment, is a brand new concept here, because it might get confused with the risk margin from the Solvency II. But Solvency II is a regulatory or market approach assumption. But in IFRS 17 is a business ongoing. So that's why the new concept, risk adjustment, is created. And then you can choose your management, your entity's management, or your side, your shareholders, to look at your entity's position in which level. So we usually in the standard says is entity specific. It might be different from one country, one company to another, because it's going to reflect on your entity's own perception of risk aversion degree or your risk appetite, because that's going to be another type of compensation in the future that goes into the profit. Anyhow, risk adjustment definition naturally is not give you the negative numbers. It always positive number, because it's going to say the volatility of your building block 1 and building block 2 together, because you simulate not just point estimate. For example, I would say distribution estimate. You can come up with the mean of the building block 1 discounted, and also the based on your own selection of risk appetite, for example 80th or 90th, and that distance as a volatility, and that's going to turn into the risk adjustment value. And these are the fulfillment cash flow, and as I already mentioned, if it shows net outflow or net inflow, especially net inflow, that number turned into the plus sign, and it's going to be turned into contractual service margin. And for example, this number should not go down below 0. It is 0 or positive. It means that this is a non-onerous group of contract. In this case, currently, we just recognize the profit in the PL statement, but the new standard says just you have to recognize this whole portion as a profit over the remaining coverage period, one by one. So one of the technical challenges is that how am I going to allocate this total amount into over the remaining coverage period? What if this group of contract is onerous and its CSM would be 0, and that outflow portion, the number just goes into the PL statement immediately. But it means then you have to put the number there and wait for the next coming reporting date to be recognized as a loss in the PL statement. So all of these 4 portion, CSM could be 0 or positive number that all sum up together to get an insurance contract liability on initial recognition. For example, 14th or 15th, when this group of a contract come into our book of business as a new business. So you measure it, this all amount, and then put it and wait for the next reporting date. That's the first step. And the next one, when the reporting date comes, and then you have to start from the results of measurement on initial recognition, and you have to measure it again for the same future remaining coverage period. And right now it is split into 2 different components. One is the liability for remaining coverage, for example, 14th and 15th, and like 2 or 3 months later, you have a first coming report date. And during the last, like couple of months that already passed, if you have some of the incurred claims and you still look into the future and measure it again, that's what is called subsequent measurement with the very same way how we measure it on an initial recognition. And then you have another set of 4 building blocks, but CSM is going to be calculated differently. So you have a CSM 0, meaning that CSM amount that you come up with on initial recognition, and you add or subtract the other, some of the items, and then you have a new CSM on the first final report. But anyhow, that new carry forward CSM after you adding or subtract some other numbers, and you have a new 4 building blocks for the remaining future coverage, and then that is the liability. So that is one part. And second part is for the last couple of months, 2 or 3 months already passed, if there is incurred claims, and still you can expect some of the future cash flows coming from those incurred claims. We called it liability for incurred claims. But here we don't have the CSM because the IFRS17 standards clearly say that all the service period that we have already provide the policyholder is happened in the past. So it's already done. So in that case, whatever you come up with the net outflow or inflow, it just goes to the PL statement as well directly, immediately, because this is on reporting date. So I'm going to show you the picture how it works. The insurance contract liability is going to be combined 2 components. Liability for incurred claims, and there will be another additional. Now, even though it's already incurred, some of the big claims in the non-life side is not settled yet. So you can expect to have future cash flows out of already incurred claims, and we measure building block 1 to 3. It's the same as measurement on initial recognition, but this one doesn't have the CSM, it just goes away. So total of just the fulfillment cash flow is going to be part of the liability from the incurred claims. And what about the LRC, meaning liability for remaining coverage? There are two cases. One is for the onerous. The first one is non-onerous and onerous. For non-onerous, it works the same way, building block 1 to 3, because it was non-onerous probably on the initial recognition, and the new CSM amount, which shows a positive number, that would be changed. So I'm not going to go into the detail, but it starts from CSM 0. Right now, the first reporting date, CSM 1. I told you we add or subtract some of the, like numbers or estimation for the future remaining coverage, and there is a new CSM. And we all add up together to come up with another portion of liability. We add those two. But if this group of contract was onerous and now onerous again, and we also estimate building block 1 to 3. And you could see, because it is onerous on an initial recognition, we just have a CSM 0. And then on the first reporting date, it is still onerous. It could turn into non-onerous, but it keeps, like on a status of onerous, and then this number couldn't go down minus, just put it as a 0 again, and then we have to establish loss component, which is the same amount of the future potential loss that we come up with. So it means that for the LRC onerous group of contract, in the liability amount, we add the future potential loss. And we are going to recognize as a loss in the PL statement right away. And at the same time, you have to set up the loss component, which is the equal amount upon the insurance contract liability. In either cases, or we add LRC and LIC all together and come up with insurance contract liability on a first reporting date. So that's how it works. And on a 4 building block approach, I want to call it, this one is quite familiar when you work in the, like any accounting or actuarial or any other department. These are all the different kinds of liability items. This is a current probably items, premium reserve, net premium or gross premium, or any other non-forfeiture reserve or unearned premium reserve, claims payable or case outstanding from the non-life side, or bulk reserve, which is incurred but not reported. The bulk reserve is also the part of the liability, and also allocated loss adjustment expense case outstanding is a part of it, and contingency reserve, and all of these liability items is going to disappear, and those are all going to be absorbed in the new IFRS 17 balance sheet as building blocks, because by definition it says all possible future cash flows, you come up with the expected value, probability weighted mean. So it doesn't matter future premium or future claim or future expense or whatever thing is going to be all observed. And contingency reserve is also the volatility, right? Prepare some of the adverse effect, but that's going to be covered by risk adjustment as well. And CSM could be 0 or positive, and this one is not fully aware of like industry people in Korea yet. Some people still say oh, we still have, case outstanding or IBNR. Why not? Yes, you could have your system ready, but it's not for financial statement preparation. Those numbers are meaningless in the financial statement. Maybe for your management or for your any like the valuation of your like employee, you can use it, but not for the balance sheet. That's a different story. And I'm going to show you the example of premium future cash inflows stochastic simulation. So I need the underwriting year when those policies are incepted, and also between calendar year development period. I have this data, and then I'm going to project the future premium cash flow stochastically, and we can get some of the 3 building blocks, the figure. And also, I'm going to show you the Excel demo for the future incremental paid claims. So as you can see, this one is accident year base, and this is a development period. And this for in the standards, it says payment to policyholder or on behalf of policyholder to the insured person. And it also covers the already incurred claims, future incremental paid, and also for the group of contract, there will be a future claims as well. So this is a very brand new practice. So everybody is having a hard time to do that. I'm going to show you the very simple example. And here, and I set up very simple model that runs 10,000 different future incremental paid scenarios, and then I summarize it into the histogram to show the distribution of all different scenarios. And here you can see I click the button, and then the macro is going to doing, this one shows like how many numbers right now. It's going to run up to 10,000 different scenarios. So from the PPT, I show you, I have the historical triangle, and I come up with the multiple decrement, like reflected persistency ratio, and I use the bootstrapping, which is a very basic, some of the sampling, the technique to generate the future premiums. So the main parameter is the persistency rate between different period, different development period. Right now it's almost done. And you can see the one that you saw was the previous results, but the new results, 53 seconds, it slightly moves. So simulation by itself, when you do simulate, like once or twice or 3 times, you wouldn't get the same results because it is quite stochastic. So later we have to develop the new practice that say how you can choose, like which scenarios, which runs actually. So you run several times to come up with the right answer, and probably or you have to set up some of the efficient frontier and to come up with the final scenario run, and then you have to report it, all the comparative statistics to the management or board. So let them have, make the final decision. And I'm going to show you additional. This is negatively skewed, which makes sense. For the claim side, as I said, in the This one is only for the already incurred claims, and also I set up in the same fashion for this one. Okay, it's going to run 10,000 different scenarios again, and as you see, it is the positively skewed, which makes sense for the claim side because you have a longer tail on this side, and again, it's the same story. You run several times or sometimes more than 10 times to create the efficient frontier, how you can determine which scenario run that I'm going to make the final decision. Remember, this is very important practice because you are going to have not only the future cash flow distribution, but also it's going to determine the level of risk adjustment. So it's quite essential. And also finish the simulation, slightly moved, right? So whenever you run it, it's going to give you a slightly different results. It might be material or it might be ignorable, but you have to come up with the final selection of scenario run. And those things are pretty much, I show you the example of cash flow generation actuarial model. And then I'm going to look into the final one. This is a most sophisticated model. Actually, I don't have my Excel demo model, but as you see, this 1, 2, 3, 4 run up to, let's say, 100,000. That is one scenario run. There is a different realization of the scenario. And right below the number is number of claims get simulated. So for example, first the realization of scenario shows 8 number of claims, and then you have to simulate 8 different ultimate claims, claim amount. So when I say ultimate claims, that all the claims will be settled, and you still have to, allocate back to each development period as incremental paid losses that you can apply some of the discount or adjustment. So this is the first step. The reason is that for the large paid losses, it's different from a traditional loss that you just saw. So we need a different actuarial model to simulate the number of claims, and accordingly, all different 9 ultimate claims, and then allocate back to the previous development years to come up with the future paid loss, incremental paid loss, cash outflows. This is one of the sophisticated model because the parameter itself is quite to achieve, but there is a model. So during the seminar we are planning right now, it might be on April or May, I can show you, a very detail of some of the insurance business operation and management, and also some of the actuarial practice, its procedures and actuarial models as an example. So hopefully I can see you on future seminar. Thank you very much.